Welcome back to Golden Rule Radio. It's a new voice, so I'm going to give Miles just a 10-second
Welcome
break.
back to Golden Rule Radio, Tori.
Well, thanks.
Yeah.
Your solo shows have carried us, and sorry to leave you hanging like that, but it's good to be back and in timely fashion, honestly. Even if we haven't had a ton of volatility, we've had a ton of news and exciting events and things to discuss.
This is a heck of a week to do a show.
It really is, and not based on some incredible chart move. And I think we should
we had some incredible chart moves.
Yeah, depending
Maybe
on
not the direction gold
and
investors wanted it to go, but we did
That's
have
right.
some incredible moves. But yeah, this is a big news week. It feels like one of those breaking point news weeks about what the next 6 months of the U.S. economic system is going to look like.
Yeah, I totally agree. And before we get into the weeds of some of those news and fundamental items, let's kind of review the charts. I'm going to ask you here just briefly, what's your next downside target on gold? Because
Sure.
That's the short-term trend. And you last week had put up a 50% retracement fib at 1789 on the short-term chart, right? On the
Right.
intermediate, I think it's like more like 1795, but they're kind of converging in that same range. Are we
Something
headed there?
sub 1800. I still think it's likely. I mean, the technical answer to your question, what's the next breaking point or bottom in gold? Well, it's 1805. It's what we hit, what was that, a week and a half ago? Because we're still not back down there yet. So we've had this declining trend since about the beginning of February, end of January, after we hit that peak back in 1960. So we knew we'd have a pullback. We did have just, at least in the short term, we had a little bit of RSI divergence where the price is going down, but the indicators are rising, meaning that it's oversold. So it wasn't surprising to see this bump up that we had in gold here at the end of February, beginning of March. But we hit that bottom in 1805. That was kind of in between a couple levels. So it didn't surprise me at all to see it take a nice little jump and then potentially come back down, and that's what it did.
That's called a dead cat bounce, right?
Sure.
we can have those in gold too. So that little pop surprised me. I quite honestly thought we were going to continue downward here. Now we're recording at 1,815 an ounce right now,
Right.
But most of that retracement was 2.7% yesterday, meaning Tuesday, March 7th. So recording here on the 8th, does anything change for you? 1805 doesn't hold. We still looking at that just sub 1800?
Yeah, I haven't really changed my tune. My tune's been, I think we'd possibly see sub 1800 on this move down. I've been saying that for a month, so that doesn't surprise me at all. I like it when indicators line up and you've got some pricing action dating back to December where it would make sense around that kind of sub 1800 level. That's lining up with your 50% retracement. So there's your 2 steps forward, 1 step back, and your 200-day moving average is probably going to come up and line up right there. So whenever you have a couple of indicators that are all coming together at the same place, you know that RSI traders are going to make a purchase there. You know that Fibonacci traders are going to make a purchase there. People who just watch price action are going to make a purchase there. So there's a lot of groups of investors who may hone in on one specific indicator over others. So when you have multiple indicators all coming together at the same place, you're going to have multiple groups of investors that are all going to get interested there. So that's why I like that price, and I think it's still likely. Now, I think it's less likely, but sure, we could have put in a bottom at 1805, and we're going to start stair-stepping up. So we'll just see over the next week. I'm still leaning towards slightly lower in the gold price. That doesn't surprise me at all that we had a big down day yesterday, given what we're probably going to finish the back half of this conversation on.
Well, and you talk about indicators lining up. There's another one lining up with this recent price action, and that's the dollar. So before we get into silver, because gold moves oftentimes, or at least in the last year, very contradictory fashion with the U.S. dollar, you mentioned in last week's show that the dollar had stalled, right?
Right.
Well, we've had a little bit of a pop now. So we're 105.66. Is that a breakout in your opinion, or is that just merely telling a story so far as to why gold has come down and only come down this far?
Yeah, we certainly could have. I mean, my big argument is that I think we're going to see the dollar retrace all the way back up to like the 107, 108 level.
You've been saying that for many weeks.
I have.
Okay.
So what ended up happening here over the last week or so is we kind of stalled out just under the 382 fib. And like you said, yesterday we popped above it. We did put in a new short-term high yesterday, and it looks like we're kind of building that out as a base now to move forward. You've got, again, looking at multiple indicators. We're only at the first fib level, so fib traders are still looking for a deeper rise before they'd be looking at sell positions. The 200-day moving average, or long-term moving average, is still above us. You've got some price action that's still above us. There's a couple things that are still a few points above where we're at now that I would argue brings me to about a 107-ish range, to where those things are going to start coming to a head together and you're going to start seeing a fist fight in the markets.
Yeah, I agree with that, Miles. And transitioning over to silver, I mean, we talked about gold's decline of 2.7% yesterday. Well, silver doubled that decline. We had about a 5.5% retracement yesterday. And with that, that's twice the percentage reduction in price, which means the ratio is going to widen. And sure enough, the gold to silver ratio has now climbed to 90-1, which we'll get back to here in a sec, because that has a lot of significance for individual portfolios and investments. Silver, does the spot price tell you a story right now, and where are we looking at support?
Well, silver did two things. We bounced the 618 fib a week or so ago. We broke below that yesterday. The second thing it did is, while we had gone back above the 200-day moving average, we've moved back down pretty strongly below it. So volatile metals move volatilely. Is volatilely a word? We're going to go with it. Volatile metals move volatilely. And we're down, like you mentioned, about double what gold did. So unfortunately, it's just not surprising. Silver is an adjacent metal to gold. It's not a replacement. It's adjacent. It's industrially focused. And we're going to take a look at the Dow here in a minute, which looks scary. The thing I do like about silver, which is, it's kind of iffy, but we do have a trend line we built back in September, October, November of last year that we're coming into now. That's kind of in between the 618 and the 786 fib. So you could see a bounce in silver actually like tomorrow for the next week. You've also got RSI divergence on the daily chart. Again, that means the price has bounced down here twice, as you can see, but the indicator has bottomed out and started to rise. So I would argue here in the short term, you should see a pop up in silver. That would make sense to me, but how high that goes, I'm not sure. I mean, you'd need to get above at least, let's say, 22 to start arguing reversal, and that's quite a ways up. So I think anybody buying into silver this week, whether it was a couple days ago or tomorrow, Friday, something like that, I'm definitely looking at silver right now with the ratio in the 85s, and like you mentioned, with this drop, now we're down at 90. So I'm a silver buyer this week. I don't really care if it goes down another buck, because it ain't going down 10.
Well, and that's what we tend to focus on with the portfolios. Coming back to that is, what's the ratio? What's the value? We measure value not on chart analysis necessarily, because that can become nebulous. Price can become nebulous, but price relative to other goods can become very significant when determining value. So when we're measuring silver versus gold, that's one of extended historical context. And that means right now that silver is undervalued versus gold. So if we are adding to our ounces, don't exclude the silver, because all you need is a 30%, 40% change in that ratio to pick up additional ounces. And that's kind of how we manage our portfolios, whether it's in an IRA or in a storage account, or a lot of times even in clients' possession. Keep an eye on the ratio, and that's screaming add to silver here as well. Yeah,
I'm always going to measure the value of the silver I own in quantity of ounces, not quantity of dollars I can turn it into. Because if you care about the ounces, the dollars will take care of themselves.
That's right. So Miles, you mentioned the Dow. Let's pivot to the equities here.
So the Dow, I've been bringing this up for a couple weeks. The Dow sort of planed out and has been sitting in this pretty massive trading range between about like 32.5 and 35,000. This multiple 1,000-point trading range. I remember not too long ago where a 2,500-point move in the Dow would have been life-changing.
Yeah, like a quadruple.
Now it just happens, which I think is kind of funny. The downside is we keep putting in a pretty flat bottom around 32.5, which we're back down to again. But the problem is the highs are getting lower. We started at 34.7, then we came up to like 34.3. The last time we only came up to like 33.5. Every time the ball bounces, it's losing momentum. With Powell's statements this week, with the expectation of what interest rates are going to do, and also with the thing we're going to talk about later, the central bank balance sheet, which I want to talk about here in a minute, I just don't see it happening. I just don't. Nobody thinks the Dow is going higher. Nobody thinks stocks are strong. Nobody thinks stocks are going to rally. No one from Washington down to you and me or anyone in between.
And if they're telling you that it will, there's self-serving interests at stake there and at heart. So take it with a grain of salt if you hear the opposite opinion. Proceed with caution.
So my next downside target on the Dow remains at about 31,200. I think at this point that's definite, and sadly I think that's maybe just a starting point.
But the fact of the matter is, it's okay. That's healthy. We really can't resume climbs in healthy fashion without those washouts, without those corrections that are so necessary for getting rid of some of the junk. They know that. I mean, systemically, we have a lot of junk, not the least of which is the Federal Reserve balance sheet that you talked about. I mean, they were the ones absorbing and buying all of the junk, and that balance sheet ballooning to up over $9 trillion at the same time that they were ignoring the inflationary pressures in the market. Then they got behind the eight ball and started having to react in the form of interest rates. And Powell's been very consistent. You said something to me.
I'm actually starting to believe him.
Yeah, he's very adamant about the fact that these rate hikes are going to continue. And now you've got even some pressure that wasn't coming. You've got Larry Summers. You've got ex-Obama advisor Jason Furman. They're both saying the Fed's got to tighten more. They're saying 50 basis points in March now is necessary. And that's kind of what Powell is alluding to. Is he not in front of the House of Representatives?
Yeah, we'll see. I mean, he doesn't want to get ahead of himself. Over the last couple days, his semi-annual presentation I hate that they call it a testimony because it sounds like he's on trial, which I guess maybe he is, but his testimony before Congress. Very short statement followed by many, many hours of questions, which we were joking earlier. I question the validity of the questions coming from the audience in an election year where everybody needs sound bites for their campaign. I don't know who's actually listening to Powell, but I don't think it's anybody in Washington, D.C. So he's been very clear. They are strongly committed to returning inflation to a 2% goal. Now, we can argue over what 2% means because
or how it's measured.
Right, because that's changed significantly over the last 40 years. But regardless of what it means, even by today's standards, we're still significantly above that, multiples above that. And we've seen already, from a percentage standpoint, drastic interest rate rises in a very short period of time, which is very clear when you look at that Dow Jones chart that we just looked at. Recently, we've had the PCE numbers come out. That's your personal consumption expenditures. They're excited to see the PCE numbers have actually slowed down, so people are technically spending a little bit less, more. I think that's actually the correct way to say it.
That's right.
They're spending less more than they were when they were spending more. Gone down from about 7% in June to 5.4% in January. So your personal outflow, your personal expenditures are technically down about 1.5%. But interest rates in that same period of time have gone up from 1.75 to 4.5. Between June and January. Now we're a little bit higher at 4.75. He's well aware of the damage that this has and will continue to and probably accelerate towards for the general consumer in the United States.
Well, and he did say, Powell, one of the things he said, you talk about that 4.75, the target peak that we've been hearing for the course of the last 6 months has been between 5 and 5.25%, and then they would pause. Well, that's not what he's saying now. He's now saying that ultimate rate peak is likely to be higher than expected. So now we're talking about going higher even than the 5.25% and leaning towards more than a 25 basis point hike in March and looking more towards 50. So that'll almost get us to that expected peak rather than easing there over the following month. But That's, again, economic data being stronger, unemployment being stronger. You were mentioning the unemployment numbers are
Right.
at their lowest since when? Since
1969.
Yeah.
According, again, we can have a discussion about how they calculate unemployment nowadays. 'Cause
that's
it's
right.
very different than they did back in 1969.
We know it's much, much higher than the 3.4%. So.
But what that does give them, whether it's legitimate or not, what that does give them that I was thinking is wiggle room. They have wiggle room to say, okay, well, current unemployment, sure, interest rate rises have caused unemployment. Now, they were 4.9. That was the lowest in 50 years. Well, they're only 6.8 now. But what does that really mean?
No, it's terrible. Okay, if the unemployment is accurate and we're sub 4%, I think, 3.4, the record since 1969, you're right, it gives him wiggle room, and he alluded to that too. Elizabeth Warren was actually asking some pressing questions about what he would say to the 2 million people losing their jobs if he keeps raising rates, because that's an expectation. Well, that's intentional. They know that raising rates will lead to an increase in unemployment. Think about that. They cause the inflation, and then the treatment of the inflation, after everybody suffers through price increases, is to then stimulate layoffs, right? So you're now going to lose your job after suffering through an inflationary cycle. And his response is, will working people be better off if we just walk away from our jobs and inflation remains 5.5% to 6%?
Mic drop.
Yeah. That's the sensitivity to the working class that these people have.
Right.
The issue here, though, is that behind the scenes, the Federal Reserve is technically doing a tightening, and we're actually seeing an M2 money supply contraction.
Right.
So we talk a lot about it on this show.
That's a good point.
So when that M2 money supply contracts, that's one thing. That's actually a deflationary action in an inflationary environment. But the Great Depression and the Depression of 1921 were very ugly because they were deflationary depression types of events. And Don McElvaney has said for decades, the big one's going to be an inflationary depression. And that's really what everybody's been talking about, is you're in a depression and you have inflation, not stagflation. You have significant inflation with a depression. Well, here's an interesting chart for us to peruse, and giving credit to Nick Gurley, who posted this on Twitter, the money supply year over year, right? Not just the money supply contraction, but what has it done year over year? Well, only 4 previous times in history have we seen it go negative, where there's a true contraction, and you were talking about it being down.
Sure, it's down about
2%.
2.5%.
Yeah. Well, the previous 4 times in history that occurred coincided with a significant depression and double-digit unemployment.
At the same time.
Right. So are they going to actually swing the pendulum too far? Are they going to drive unemployment too far, right? The last time was in the 30s when unemployment went over 25%. Okay, but it hasn't happened since then. So you've got a couple scenarios here, Miles. Either they wait too long and unemployment goes too far and deflation goes too far, or they get scared and they do what?
They soften.
They
go right back into an inflationary cycle, and they tank interest rates, just like Bernanke did, just like Yellen did, and just like Greenspan did.
And they start printing again. They start that easing, and they start printing. And when that happens, with all this money in the system, because it may be contracting, but it's still astronomically high, highest obviously in history, trillions of dollars. When that happens, watch gold explode.
I just keep saying the same thing for months, man. Who is Jay Powell going to be? I just don't know.
Is he Volcker or is he Bernanke?
Is he Volcker or is he Bernanke? Yeah, I used to say, is he Volcker or Greenspan, but I think Bernanke's a far better comparison there. So if we're not done scaring you yet, following up on your discussion about the limited impact that we've seen these interest rate measures have thus far, Powell even said that in his opening statement. He, quote, said, there is little sign of disinflation thus far. So as much as they've done, as much as it feels, as much as they've done thus far, not only has it not been enough, they're barely even getting started.
That's right. But that's not all. If we haven't scared you enough.
Right. Yeah. One more. We're not done yet.
Before we leave the show, I want to bring attention to the increased tensions geopolitically. And I'm not going to go into a bunch of details, but get your radars on. Yeah, that's a play. Okay. You've got a lot of strong talk of dire or significant consequences coming out of Russia for our involvement with Ukraine if we continue. You've got the strengthening of the ties between China and Russia. You've got China talking about the United States better back away from Taiwan. You've got a 4-star Air Force general talking about the fact that his gut feeling is that we will be at war with China in 2025. And you have House of Representatives members talking about the fact that they believe that within the next 2 years, we will be in a conflict with China. Those are scary words. That's warmongering. And keep in mind, when you have things like this deflationary depression and losing control of the markets and treasury yields going sky high, oftentimes the answer is conflict.
So that's going to do it this week for Golden Rule Radio. Again, appreciate you stopping by. Thanks for stopping by, Tori. Welcome back, and glad to have you back in the studio. What a great week
I'm glad
to
you
pick
have,
back up on.
Yeah, that's right. I'm glad you have your normal voice back.
Thanks. Yeah, you were out of town, and I was working from home last week. So anybody who suffered through my solo show last week, I apologize for the little bit of sick that I had in my voice. But it's good to be back in the studio. Appreciate you joining us again as well this week. If you liked what you heard, do the YouTube things. You probably know where the buttons are by now. It's been like 20 years of YouTube. But better yet, if you liked what you heard and you want to discuss your personal portfolio with somebody here at McIlvaney Precious Metals, why not give us a call, sit down, chat with one of the advisors. We can be reached at 800-525-9556. You can also find us on Twitter. We're at ICA Gold, or on Facebook at McIlvaney Financial. Thanks for listening. We hope you have a great week.